traders, Mark Chapman here, the creator of the trademark Trap Traders concepts. Welcome to today's Trap Traders Trade of the Day analysis. Today's date is Wednesday the 31st of May 2017, and the chart we're going to take a look at today is New Zealand dollar on a 4-hour chart. And we had been watching these levels where you had this cascading effect, and you have a series of lower highs, and that can act as a trap. And when price comes back into the area, we did see a little bit of a reaction, but nothing major. Nothing turns at the level proper. So when you get a situation like that, you just keep going. When you've got a fundamental understanding of the currency where you want to go with it, you just keep going higher in this case to see if there's anything of interest. And I just want to highlight this area, the 70, 88, 90 level, and why it's interesting, just to give you a little bit of an understanding of how on the face of it a level might look as if it's broken and broken out to the upside or the downside, but in actuality what can be happening is the level can be getting worked so that it actually triggers stops and induces, seduces different types of traders into the position, so that something big, right, a big institution, several of them, etc., can start to, in this case, essentially sell in the face of buying. And what do I mean by that? Well, it's very typical, I'm sure you're aware, that when you have an area on a chart where you get price turn very cleanly, it's very precise turn at a certain price point, what that does is that then is marked up on a chart, if it's nice and obvious, as a level of support resistance, in this case resistance. And a double top is a very common trading strategy for a level trader, and part of understanding how order flow works at a level is actually taking on board the behavior of the traders who would take those trades. We've all been those traders, you know, at some point in our careers. If you've been around a while, we've all been level traders, retracement traders, breakout traders, very momentum type traders. There's really only 3 major core disciplines that you can be as a trader. There are obviously unlimited amounts of strategies, but there's not that many different core disciplines. And what that does for us is it makes it very easy then to deconstruct, reverse engineer the behavior of those traders so that we can see them on a chart and understand when they're in trouble, understand what's happening with the order flow, so that we can try and position ourselves to take advantage of their mistakes, their weaknesses, and also allow us to trade on the coattails of hopefully something big that was doing, I say something as a singular idea, obviously that's not the case, it's more than that, but it's just easy to think of it in those terms, something big, so that we can ride on the coattails of their trading. Because what they will do is they will prey on the very typical behavior of your standard trader. So when you've got an area on a chart where you've got a double top, right, double top like that, what happens is a trader goes short, and where they're going to place the stops, right, you guessed it, just above the level. And this is just a fact of how order flow works at a level. What you get is a clustering effect. Imagine you could see the orders, right, where people were placing stop losses, and these are the people who are going short off this level, right? So resistance trader going short off the level, and they'll place the stops, they'll cluster very heavily around the level, and you'll get some more orders higher up, right, a little bit more sporadic the further you go away, because what happens is people try to manage risk and try to pick off tight entries, so that the behavior is very typical, and you get these clustering effects in and around certain price points, and a double top, triple top, etc. would be some where that will occur. Now if we just take a look at what's happened closer in this example, zoom right in, imagine at the hard right edge you were faced with this image. So you've been watching the level in question, and this is what you were met with, right? This is in many ways a level trader's dream. It comes to the level that they've been watching, it sells off at the level. Not only does it sell off, it's an engulfing candle, and it closes really right at its lows, you know, signaling an extremely strong situation for the bears, or that's what you would think, that's what you've been taught. Now if you had just placed an order at the level, obviously this doesn't include you, but most people don't do that. Most people just don't place orders at levels anymore. You know, it's very nice in terms of an idea. It's good in theory, but it rarely works in practice, because it's beyond annoying if you have a level and price just creams through the level and you've got orders sat there and you knew by the behaviour of the price action at the level that it wasn't holding, yet you just got creamed for no reason. It's kind of pointless. So what happens is when you go forward and you gain that a little bit more experience, people do want that little bit more confirmation. When you hear people say confirmation, you know, is a bad thing, you know, they're just idiots. They don't pay any attention to that, because there is, you know, some very logical steps you can take when price comes to a level that if you've just got orders placed there, you know, you sort of just abdicating responsibility of taking charge of that scenario, and there's no reason to lose most of the time. And that's what happens when people try that, because it seems like a good idea. People try it initially and they get creamed, so they don't. They want to see behaviour adjust. They want to see a little bit more confirmation at the level. Now, whether or not that's a closed candle, whether or not that's, you know, just a reaction off the level, you know, it doesn't necessarily have to close for them to come in. And you've got to remember as well, this is just one time compression. This will look different the lower down you get. But just presupposing we're trading off the forward chart, we're going to wait for a close. That is eye candy, a dream to a level trader if you were trading at the hard right edge. This is perfect. And what they would do is they would place the stops above this level. They'd take the trade, place a stop above the level, and then they'd have some type of profit target, you know, wherever, down in here or lower. Now, that's what I refer to as entry cheese. So just think about how traders take trades, right? This, if you're doing the analysis, it's all historically based. So you've realized that there was a turning point in price at a certain level, and then price comes back up to that level. You're now poised to take a trade, but as I said, most people want to see a little bit of confirmation, and when you get it, that's what makes you actually take a trade. It makes you pull the trigger. It's this that does it. Right? It's the confirmation that your ideas, based on that historical analysis, are actually coming to fruition. It looks as if it's starting to work. It's like an optical illusion. And that's what makes you commit capital, because until that point you haven't committed capital, most likely. It's the price action at the hard right edge, this being the hard right edge, right? Big void we've got to the side of all our charts. Right, where the price is in the here and now. We don't focus on what's sort of coming into the future. It's all focused on the here and now and that historical analysis. And if price in the here and now starts to react, we'll pull the trigger, we'll jump into the trade, and then our behavior becomes again very typical from there, because we'll place our stops right above these structures. Now let's just imagine that was the case in this scenario. So people go short and it looks good now. People, maybe some retracement traders went short in there, and some micro structures lower down. Oh dear. Hopefully praying now it sells off. If you haven't been caught, you probably caught most people at this point. This could be the sell-off we've all been waiting for, because in real time this would have been negative, but it obviously closes as a bit of a doji spinning top, so it's not looking great at this point. And boom, that would have been the candle that got you, right? That would have been the candle that stopped the vast majority of people out, because our stops were just above the level. Now then, let's just keep going forward with this and see where we're at now. Now then, it stopped a lot of people out, so just let's understand the order flow of that scenario. So those orders that got stopped down there and got hoovered up, essentially, if you sell, which is what you would have done in here, that particular type of trader, then your stop loss, the order, if you sell that, equals buy contracts as a stop loss. Okay. Now those buy contracts, if you think about a big institution, maybe they want to sell here too, but selling at the same price everybody else is selling is no good, because if everyone's selling, then there's not enough liquidity for them to take a massive trade. Now what they need then to get off their orders, if they need to sell at this position too, or in and around it, is they need buy orders to be triggered so that they can start selling that. Now when the stop loss gets breached, what that is essentially is that's buying, but it's forced buying. Nobody wanted to be stopped out, right? So it's forced buying. Most people never discuss the fact that there is a difference between sort of willing buying and selling, or motivated, you know, in a good sense, buying and selling, which occurs, you know, if you're profit taking, that's, you know, you're highly motivated, that's a pleasurable experience for many people. But forced buying and selling is a completely different animal. It's not something people like, but it's forced nonetheless. So as it goes up to that level, imagine then, if you're a big institution, what you can do is you can start selling as those buy orders get fired as price goes up to the level. Something big, a big institution, will sell as price is going up. So just remember that. Right? They'll sell in the face of buying because it allows them to do business. It also allows their movements to be sort of covert, if you like, right? But they've got, it's not as if it's some type of conspiracy. It's just the way that they have to transact. Okay, their orders move markets, and they can't do business where everyone else is trying to do business, although everybody is trying to do business in the right way, i.e. sell high, buy low, right? But if everyone's selling at the same spot, then that's not going to work for them, because they've got huge orders that move the markets. And if they just did all their business in one place, you know, the price would be down here. It would collapse. It moves markets, so they can't do that. It's referred to as an iceberg order. They've got to, it's the tip of the iceberg, right? They've got to hide their movements, and they've got to buy and sell bits at different price points, averaging their overall position to shorter distance to profit as well. And it's done in a way that you just don't notice it's going on. So there's been some buying occurring in here. Now then, when price pulls back into the level, what's a very typical technical strategy? Well, there's two things that's gone on as well in this scenario. As it broke up through that area, you'd have had some breakout traders go long too, and as it pulls back, now what you're going to get is you're going to get retracement traders who trade pullbacks to a level. Now then, just think this through. There was buy-in from the stop losses, right? The forced buying from the stop losses. As it breaks up through the level, it's not the world's greatest breakout. That's why I didn't mention it, because it's sketchy whether or not breakout traders would go in after so many positive candles in a row. There will have been some people, but it's obviously low probability breakout, momentum type trading. But nevertheless, these are buy orders, and so these. But this is willing buying. See the difference? A minute ago this was forced buying as the stop losses got nailed, but in here, as price breaks up, this is willing buying. Now as price pulls back, guess what that is? It's willing buying again. Retracement traders buying off structure, because it's very typical for people to believe that former resistance, when it breaks then comes back, becomes new support. So traders go long again in here, in this candle, believing that it's going to follow through and make new highs, right? It made a high here, a new high there, pulls back, and they go along. Place the stops, interestingly, below the level, right? Sell orders as the buy, go long, hoping it will follow through. Now again, if you're a big institution, you've been selling in the face of that breakout, you've been selling as those forced stop losses are nailed, and you can start selling again as more people pile in, believing, you know, technically at the hard right edge, believing it's going to follow through. Allows them to do more business. Right, now then, what this could be is essentially, it could be a stop hunt, and levels will breach more often than they don't. It's perfect cannon fodder for some big institutions to do business and just totally spank the traders, right, at the level where they wonder what the hell's gone on. Right? If you were the seller in here and price ends up down here, you know, in a couple of hours time, and it drops like a stone, but you got creamed at the level because you were just sort of looking at it how it's described most of the time, very non-linear way, you don't understand the order flow at the level, you get absolutely moosed. But then when price is down in here, you're wondering, you know, Jesus, what the hell can happen. It's too late for you. You know, you're not going to enjoy any of that process. But if you understand that process, and it can be more complex than this. It's not. This would be considered simple if this just dropped from here. This would be a very straightforward, typical stop hunt. But it can be a lot more complex than that. Anyway, if it does develop, then it does. If it doesn't, but I'm just trying to show you at the hard rate edge in real time how these things look, so you can start to train your eyes so that you can get on the coattails of these big institutions rather than always being nailed by them. Understand the game that they're playing so that you can be smart and watch how price develops and understand the order flow, and then jump on board and take advantage of their moves, rather than always being on the wrong side of that equation. So if you'd like to learn more about how I do this and how we trade the financial markets in this way, then there's a link below. Click the link below, share this video with your friends, and come join me in my inner circle. Tonight we've got a training session, so it's a great time to come and join me.